welcome back to my channel. So today is officially the day, y'all. The website is up, so feel free to visit the site. I'm really hoping that y'all like it as much as I do. A lot of work was put into it, so shout out to my website developer. But yeah, the website has been launched. With that being said, hence why today's video is all about understanding the basics of options trading. I have made quite a few videos so far discussing the elements of investing, but I've yet to discuss the essentials you'll need to start. So that's the premise. And keeping in line with that, if you visit the website, I do have a free course and it correlates to just understanding the basics as well. I have a paid one too, but the free course is perfect for beginners. And I know a lot of my subscribers are new traders, so I wanted to offer y'all a free resource as an intro. So if you're brand new to trading and investing, I'm sure you'll find some value in it. So yeah, feel free to check out the website when you get a chance and tell me what y'all think. And just grow with me. The community is new. But let's go ahead and dive into this video all about understanding the basics of options trading. Okay, so I do realize that I've never made a basic video providing the simple information about options. So this video is a bit overdue, but there's no better time than now to fully introduce these concepts. So if you're a beginner trader, you can fully grasp how options trading works. So let's go ahead and start by defining what options trading is. Essentially, options trading involves financial contracts, and these are known as premiums. They give a buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a set time frame. Now, there are two types of options that you can purchase. One is calls. Now, call options anticipate a stock or ETF will increase in value, while a put option anticipates the opposite, that a stock or ETF will decrease in value. And because of that, every contract comes with a day of expiration, and this is known as the DTE. The DTE can range from 0 days to months out. I have previously made a video discussing DTE, so I'll leave a link to that down in the description, but let's dive a little further into the basics. Now, because options trading is a bit nuanced, there are two primary factors in trading, and this involves technical and fundamental analysis. Fundamental analysis entails a focus on the intrinsic value of a stock. This means that there's an evaluation of factors such as like the earnings report, the revenue growth, assets, liabilities, and other economic conditions. It also involves analyzing a company's income statements, their balance sheets, and like cash flow, while technical analysis involves relying on the evaluation of chart data, such as like trends or chart patterns, and this entails understanding price motion and volume. Along with that, there are two common types of trading, which is day trading and swing trading. Now, day trading is simply a quick in and out of a position, while swing trading involves holding a stock beyond the end of a trading day. I will say both methods have their advantages when traded correctly. The last thing to note about the basics of trading is that the key objective is to buy assets at a lower price than what you sell at in order to maintain and hold your profits. So with that being said, let's take a deeper look at an example of an options chain. Alright, so I have a screenshot of Square pulled up, and this is the actual option chain for Square at the time of filming this video. So I'll break everything down. Starting at the top right, you see the ticker symbol is of course SQ, and this is just the acronym in which the stock is identified. So for example, if you wanted to search for Apple, you would just simply type in AAPL, or Tesla would be TSLA. So underneath that, you see a breakdown of data for the stock. The first thing it shows is the 52-week low. Under that, you see the yield, and the yield is basically your ROI in a way. It's a way to see like your return on investment. And you usually see this number as a percentage of interest that's returned. Next to that, of course, we see the PE ratio, and this just compares a company's share price to their actual earnings. This helps investors determine if a company is performing well or if they're underperforming by looking at the numbers to see if they're overvalued or undervalued. And then underneath the PE ratio, you see the EPS. This is similar in a way, but it differs in the fact that it measures a company's earnings per share. And the higher the earnings per share, the greater the profitability and value is perceived to be by shareholders and investors. And then you guys can see on the right side of that, we see the dividend. Now the dividend is going to be what you're paid out every single month, or if it's every quarter. And of course I made a video kind of explaining that, so I'll leave again that link down below. And then underneath that, you see the dividend frequency. That's going to tell you again how often. And that just, again, breaks that down. So you know the percent with the dividend is going to tell you if it's like 2%, 3%. The dividend frequency is going to be how often. To the right of that, you see the ex-dividend date. Now, this is often confused with the payout date, but that is not what the ex-dividend date is. This is usually one business day before the record date. And investors who purchase a stock on or after the dividend date, they won't receive a dividend payment. Instead, they'll have to wait until the payout comes around again. And that just, of course, lets you know that, you made your investment, it's there, but you won't get paid because you didn't meet the dividend date for it, okay? All right, and then, of course, we see shares. That's just going to tell you basic what you need to know as far as how many shares are being held at that particular point in time. And then on the right side of that, you see the beta. Now, the beta is a concept most people don't talk about too often, and this just means the anticipated motion in the stock or ETF, and it's relative to the movements in the overall market. So generally, a beta that's higher than 1.0, this indicates that the stock is more volatile than the market itself. And a beta that's less than 1.0, it suggests that the stock has lower volatility. And then the very last thing you see is where it says last size. And this just shows the most recent or last trade for a stock in reference to how many shares were bought or sold. So that's the basic breakdown of what you would see. So now let's go ahead and take a look at a few other details so that you guys can get the full scope of this. All right, so at the top right, you see the share price. Now, I have previously made a video talking about you need to multiply by 100, but this does not apply to the share price. Some people may be confused by that, but let me kind of break it down in this way. Whatever you see for the share price, no matter the number, that remains constant. Obviously, it's going to change, obviously, if the stock moves up or down, but the number does not have to be multiplied is what I'm saying. So you see the 63.39, that's exactly what the share price would be at the time of the screenshot. Underneath that, you see that green, it's like a little arrow pointing up, and it's a 0.10, and then it also has that plus of 0.16%. That's going to tell you that the stock is in an uptrend based upon the fact that it's up about that 0.16%, okay? That's going to be a breakdown of that. And then on the right, you see the sell and the buy, that red and that green. That's going to be the bid size, and then, of course, the ask. Simple and plain, okay? All right, so let's go ahead and take a look at what we see in the middle of the screen under options. First thing I want to point out is the strike price. And the strike price is going to be the projected new price of the stock. So we see that, of course, Square is trading at 63.39. If you wanted to, again, make a play for calls, and let's say you thought the stock would rise by $1, you're going to look at the strike price that's $1 above the share price. So in this case, you would look at the strike price of $64. The opposite is also true. If you anticipated the stock to fall by $1, you would then go ahead and look at the strike price, in this case at $62, because you're looking to make a play for puts. Okay, so let me show you on the left side of the screen, it's always going to be the calls. On the right side of the screen is always going to be the puts. And then, of course, the bid and the ask, that contract price, is going to be what you would essentially choose. Some people buy the bid, some people buy the ask. It just depends on what you choose for your strategy. Personally, I like to buy the bid because it's usually cheaper. 9 times out of 10, actually, is most of the time it's going to be cheaper to buy the bid and sell the ask. That's just the way the stock market is set up. So just keep that in mind. All right, so now that we have these concepts, I want to go ahead and hop into Thinkorswim so that you guys can see this applied within the actual option chain that you would see. All right, so I'm keeping Square pulled up here on the option chain in Thinkorswim just to kind of provide more context. All right, I don't want to fail to mention that underneath options, you guys see on the left side of the screen, you see where it says spread, and then underneath that, you see a blue custom button. You can go ahead and select that, and you can change your spread if you want it to be single, vertical, diagonal, straddle, whatever you would want. Now, that's a little complex to explain in this video because I want to keep this, again, beginner friendly, but I'll make a future video explaining how you can customize your spread. All right, so next to that, you guys see the strikes, and you see a blue 10. You can select this as well and go ahead and change the amount of strike prices that you would see. You can have it set to 25, 50, whatever. All strikes can be shown. Anything you select can be pulled up. So I'm going to leave it set to 10 just simply because that's what I like to see when I'm looking at my chart. All right, so on the right side of that, you see IV. Now, this is something I love to stress to you guys because it's not something to ignore. The implied volatility is so vital to making sure that you're a profitable trader, because it's important to note, what is the stock motion doing? Is this going to be a stock that's extremely volatile? Now, some people may steer clear of trading stocks that are volatile, but you also are kind of reducing the amount of money that you could make by doing that. Because the more volatile a stock is, you actually have more of an advantage to make more profits. Why? Because the stock prices are going to be increasing high and low depending on, whatever direction it's going in. And that also dictates the option price. So typically when stocks are extremely volatile, the option contracts are going to be a little bit higher. Those premiums are going to come with that cost because the volatility is high. So keep in mind what you have for your implied volatility. Never ignore that. And then you see the implied volatility percentile. It'll tell you, obviously with this example, it's at 30%. And then VWAP. Again, same thing. Keep in mind what the volume is doing, what the volatility is doing. And then, of course, make sure that's something you never ignore. All right. So now let's go ahead and take a look. I want to show you guys, I've shown you in previous videos, so I'm not going to go too heavy into it, but I want to show you guys a little bit of details about the actual options chain. All right, so we're going to go ahead and take a look. I'm going to actually collapse the weekly for June 28th, and I want to show you guys how these contracts essentially are set up. So again, first thing to know is that whatever date you're at, that is essentially going to determine your DTE and how many days out these contracts are going to be able to, has to be set to expire. So for example, if you look at July 5th, that's obviously going to be 7 days to DTE. You look at July 12th, you see it in parentheses, the 14, that's going to be 14 days until these contracts expire. Now on the right side, you guys can see that there are percentages and then there's a plus or minus in parentheses. So for example, for June 28th, it shows 70.51%, and then the plus or minus is 1.346, and that's on the right side of the screen at the bottom if anybody's wondering, okay? So these are going to be things to keep in mind as well. One thing I do want to pinpoint is that the DTE also is going to come with essentially what you would see for that delta, gamma, theta, and vega is going to vary with the DTE. Why? Because contracts, again, the volatility, all that stuff plays a huge role in determining the prices. So let's take a look. I'm going to hit the drop down for July 5th. I want you guys to take a look at the ask price if we were to go ahead and make a play for calls at the $64 strike. Look at the ask price for that. Look at the bid. And then, of course, look at the delta, gamma, theta, and vega. Okay, so I'm going to do the same thing. You guys can see that here. Now let's look at it for puts. If you were to look at $62 as a strike, look at the bid, the ask, the delta, gamma, theta, and vega. Okay, you see it there. All right, so keep those numbers in mind. I'm going to collapse this, and let's go out to, let's say, January of 2025. I know that's a long time from now. Not too long, but you guys can see. All right, let's take a look. If we were to look at the same strike price, essentially close enough to it. Let's look at, because they don't have it for $64 exactly, but let's look at 65. You see the bid price, you see the ask, you see the delta, gamma, and theta. Why do you guys think that is so different? I've explained it to you before, right? Remember, the DTE is going to determine a whole lot in terms of what you would essentially make or break for your contract. So keep all these factors in mind. Swing trading, again, that's a whole nother video I'll make. But again, make sure that whenever you're entering into these contracts, you know exactly what you're getting yourself into. Okay, so again, I'll do the same thing. Kind of look at the puts. If it's under $63 now, so look at the strike price for $62 or look at it for $60. I don't know why people don't trade the 0.5. Me myself, I don't do it either. Just to kind of, this is like a little sidebar. Most people don't trade strike prices that have a 0.5 or any point anything after it. I don't know if that's just the psychology of trading or what, but most people do not trade 0.5s. I avoid it myself. I can't even lie. Like if I see a strike price that's not a whole number, I just don't even bother with it. But anyways, that's not the point of this. All right, now I feel like I'm rambling. So I'm going to go ahead and wrap this video up. Again, the stock community, the trading community is now open. I'm extremely grateful for all the love that y'all have shown me. So, yeah, I hope this video was helpful for some. And if you did find value in it, feel free to leave a comment down below. I thank y'all so much for watching, and I'll see y'all in my next video.